Hi there, I'm Tim Cantrell. I'm a certified financial planner and principal investment advisor at Applied Capital here in Nashville. Are you a self employed realtor looking to build a solid financial future? You work hard to grow your real estate business, but are you growing your retirement savings? Recently, I had the opportunity to speak with a couple of realtors that I deemed to have received questionable guidance from their tax preparer as to their retirement plan selection. It prompted me to create this video. The information in this video can potentially save you over $100,000 a year in taxes. In it, I will cover simple IRAs, SEP IRAs, individual 401ks, and even defined benefit plans, and how to select the right one for your circumstance. We'll break down how each plan works, their benefits, and some important considerations so that you can make an informed decision about which one is right for you. First, it's important to understand that as a self employed person, you're considered the employer and the employee for retirement contribution purposes. So you can control both sides of the equation, which can be very advantageous for you. Okay, so let's get started. First up is the Simple IRA, or Savings Incentive Match Plan for employees. Simple is designed for a small business with less than 100 employees. It's a great option for self employed professionals like realtors running a small team that receive W 2s. The Simple IRA allows for both employer and employee contributions. And as an employee, that's you, you can defer up to $17,600 in 2025 into your Simple IRA account. And if you're over 50 years old, there's an additional $3,850 catch up contribution available for a total of $21,450 available as an employee deferral. Employee deferrals apply to the tax year in which the withholding occurred and should be deposited into the employee's account no later than 10 days from the withholding date. As the employer, you're required to contribute as well. You have two options. You can either match employee contributions dollar for dollar up to 3% of the compensation, or make a fixed contribution of 2% of compensation, regardless of whether any salary deferrals were made. One of the biggest advantages of a simple IRA is that it's easier to set up than a traditional 401k and has lower administrative costs. However, keep in mind that the contribution limits are lower than those of other plans like a SEP IRA or individual 401k. So if maximizing your retirement savings, if maximizing your retirement savings is your top priority, this may not be the best fit. Keep in mind that an employee for this purpose is a non-spousal employee. If your employee or partner is your spouse, the ERISA laws do not apply. ERISA is short for Employee Retirement Income Security Act. It was passed in 1974, and it sets the standard for private retirement and health plans. However, it does not apply when you do not have any employees. To recap, a simple IRA is a good choice if you have non-spousal employees. However, if you do not have any employees or your employee is your spouse, then one of the other retirement plans available will be a better option for you. So let's move on. Next on our list is the SEP IRA, which stands for Simplified Employee Pension IRA. As the name suggests, it's designed to be simple, both to set up and to maintain. The plan has been around for many years and is a favorite recommendation of tax preparers. It has minimal administrative overhead and offers generous contribution limits. A SEP IRA is 100% funded through an employer contribution. The contribution is a percentage of your income. So if you're filing as an S Corp, the limit is 25% of your W 2 wages. Dividend income from the S Corp is not considered eligible income for the employer match. If you're filing as a sole proprietor or an LLC, all of your income is eligible for the match. The limit works out to be about 20% of your income less the employer portion of FICA taxes. So the exact amount's a little harder to calculate. You do have until the tax filing deadline plus extensions to make the employer contribution. So you have time to figure out the maximum amount. In 2025, the contribution limit is capped at 70,000. So you will have time. So you would have to draw 70,000 divided by 25% or 280,000 in W-2 wages to reach the maximum contribution limit when using an S Corp. As an employee, you're not able to make a deferral contribution. This means if you're over the age of 50, that you will not be able to make the deferral catch-up contribution. If you ever decide to hire employees in the future, you'll need to contribute the same percentage of their compensation as you do for yourself. So if you're planning to grow your team down the line, this might not be the best long-term solution. However, keep in mind you can, as your business grows, you can always change retirement plans in the future. Now let's talk about one of my personal favorites, the individual 401k, also known as a solo 401k. If you're looking for flexibility and high contribution limits, this plan might be perfect for you. Here's how it works. With an individual 401k, you can contribute in two ways. First, as an employee, and then as an employer. As an employee, you can defer up to $23,500 in 2025 into your account. And if you're over the age of 50, there's an additional $7,500 catch up contribution available. On top of that, as the employer, you can contribute up to 25% of your net earnings. This is the same as the SEP IRA. So with an individual 401k, you can keep the same contribution capabilities as a SEP IRA and gain the ability to perform an employee deferral. The deferral capability allows you to get to the maximum contribution limit more quickly. For example, if your W 2 income was $186,000, you would be able to contribute $23,500 as an employee deferral and 25% of your income. So 25% of 186,000 or 46,500 for a combined contribution of $70,000, which is the defined contribution limit for 2025. If you were using a SEP IRA, you would be limited to the 25% employer contribution only. So your total contribution would have been capped at $46,500, leaving you well short of the maximum contribution limit of $70,000. With an individual 401k, you have until the tax filing deadline plus applicable tax filing extensions to make both the employee deferral and the employer contributions. So this year, it could be as late as October 15th. With an employee deferral, you also have the ability to use an individual Roth K account. A Roth K account is an account where your after tax contributions grow tax free. It is a tax free, your contributions are tax free upon withdrawal. So, depending upon your marginal tax bracket, you might choose to make a pre tax or after tax contributions or a combination of both. I should note that the Secure Act 2.0 did authorize the ability to make Roth employer contributions both for SEP IRA and 401k, but that's for another video. An individual 401k is a type of a 401k. It is not an IRA. As such, an individual 401k balance does not count as a pre-tax IRA balance for Roth conversion purposes. A SEP IRA and a simple IRA balance do count. As such, if you would like to utilize annual backdoor Roth conversions, an individual 401k is ideal. Please note that when your individual 401k account reaches 250,000 in assets, you'll need to file a form 5500 easy annually with the IRS. This is an informational filing form. It does not impact your tax calculation. Finally, we have the defined benefit plan or DB plan, which is often referred to as a traditional pension plan. This option is ideal if you're earning high income and want to save aggressively for retirement, especially if you're getting closer to retirement age and need to catch up on savings quickly. With a defined benefit plan, contributions are based on actuarial calculations designed to provide a specific outcome at retirement. For example, $200,000 per year starting at age 65. Because these plans are tailored to your individual circumstances, like your age and income level, they often allow much higher contributions than other plans we've discussed today. When using a DB plan, there is not a defined contribution limit. The benefit limit for 2025 is $280,000. The amount is indexed for inflation and should not be confused with a contribution limit. If you are near retirement and have high income, you potentially could put more than $300,000 a year into a DB plan on a pre-tax basis, cutting your tax bill by over $100,000. As an added bonus, you can pair an individual 401k with a DB plan. Your contributions are limited to 6% to the individual 401k, but that can still add up over time. So, what's the downside? Defined benefit plans are more complex and expensive to set up and maintain compared to other plans like SEP IRAs and individual 401ks. They require annual actuarial reviews and ongoing funding commitments, so they're best suited for individuals with high income and a strong desire to maximize their tax deferred savings. Now that we've covered each plan individually, let's do a quick recap so that you can see how they stack up side by side. The simple IRA allows both employer and employee contributions, but has lower limits and less contribution flexibility when compared to other plans. It's great if you have a small number of employees, but generally, simple IRAs should not be used if you do not have any employees. The SEP IRA offers high employer contribution limits and offers simplicity, but the lack of an employee deferral and employee deferral catch up contributions may limit the amount that you can contribute. The individual 401k provides maximum flexibility with high contribution limits, contribution timing flexibility, and Roth contribution options. It also is not considered an IRA, so it does not interfere with annual backdoor Roth contributions. The defined benefit plan offers the ability to save the most on a pre tax basis, but comes with higher administrative costs and complexity. It is ideal for high income earners, especially those nearing retirement looking to save aggressively. So, which plan is right for you? That depends on your income level, savings goals, and whether or not you plan on hiring employees down the road. If all this sounds overwhelming, don't worry. That's what we're here for. As investment advisors specializing in working with self employed professionals, I'd love to help you design a personalized retirement strategy tailored specifically for your needs. Feel free to reach out. I'd be happy to schedule an initial meeting with you. Thanks so much for watching, and please share this video with any fellow realtors who you think it might be helpful.